Yesterday, four space stocks gained between 15 and 20% in a single session. Today, the same sector is giving most of it back. YSS alone is down roughly 13 to 16% intraday as we record this. Anyone who saw that green candle yesterday and hit the buy button is now sitting on a significant loss in under 24 hours. Not a week, not a month, one trading day. So the question worth sitting with is not whether space is a good sector. It may well be. The question is, what exactly happened mechanically? And how do you make sure you are never the liquidity that funds someone else's exit? Let us start with what we actually know, because the worst thing you can do in a situation like this is construct a narrative before examining the mechanics. York Space Systems, Voyager Space, Firefly Aerospace, Intuitive Machines, these are not large-cap household name companies. They are small to mid-cap names operating in a sector that is still largely pre-revenue or early revenue at the commercial scale. That matters enormously for understanding price behavior. When a catalyst hits a sector like this, and in this case, the catalyst appears to be a combination of renewed government contract speculation and broader defense and space infrastructure momentum in 2026. The price response is structurally amplified. Here is why. These stocks carry relatively thin average daily volume, compared to, say, a large-cap aerospace name. When retail and momentum-driven institutional flow hits simultaneously, there are simply not enough sellers to absorb the demand, without the price moving violently upward. A 20% single-day move in York Space is not necessarily a signal that the company became 20% more valuable. It is often a signal that buy orders overwhelmed available float. This is the first lesson. In low-liquidity sectors, price is not always information. Sometimes price is just the result of an order imbalance. The two look identical on a chart in the moment. They feel completely different 6 hours later. The actionable insight here is straightforward. Before you chase any sector spike, check the average daily volume of the stocks involved. If yesterday's volume was 3, 4, or 5 times the 30-day average, and in several of these names it was, you're not entering a trend. You're entering a crowded room where everyone is already looking for the exit. The reversal today is not surprising to anyone who has studied how thematic sector momentum behaves quantitatively. What is worth understanding is the specific mechanism, because knowing the mechanism changes how you respond next time. When a sector moves up 15 to 20% in a single day on no confirmed fundamental change, meaning no signed contract, no earnings beat, no regulatory approval, the move is classified in market structure terms as a momentum expansion without a fundamental anchor. These moves have a well-documented tendency to retrace, because the buyers who drove the price up were not making multi-year investment decisions. They were momentum traders, algorithmic systems chasing relative strength signals, and retail participants reacting to what they saw trending. Their holding period is measured in hours, not quarters. Once the buying pressure exhausts itself, typically within 24 to 48 hours if there is no additional catalyst to sustain it, the same dynamics that pushed prices up begin working in reverse. Early momentum traders take profits. Algorithmic systems that flagged the sector, overbought on a relative strength basis, begin reducing exposure. And critically, the retail buyers who came in late now hold positions at the top of the range with no fundamental reason to hold through a drawdown. They sell, and their selling feeds more selling. YSS down 13 to 16% today, while the original catalyst is still nominally intact, is precisely this playbook executing in real time. Here is the concrete data point worth anchoring to. Academic research on sector momentum, including work published by Jagadish and Tietman, and more recent studies on thematic ETF flows, consistently shows that short-duration momentum spikes in small cap, and thematic names revert significantly more often than they extend. The extension case requires a follow-on catalyst. Without one, You are statistically playing against the house. Not financial advice, but that is a ratio worth knowing before you enter, not after. Let us be precise about who gets hurt in a setup like this, because it is not the people who entered 3 weeks ago on a position they sized appropriately. It is specifically the people who saw the green candles, felt the urgency, and bought within the last session of a parabolic move. That is chasing, and it is worth examining not as a moral failure, but as a cognitive one, because the brain's response to a fast-moving green chart and the brain's response to a physical threat activate overlapping neural circuitry. The urgency feels real. It is not a data signal. Here is what the behavioral finance literature calls this. The fear of missing out is not a personality flaw. It is a documented bias called recency weighting, where the most recent price action is given disproportionate predictive weight. The antidote is not willpower. It is pre-commitment to a rule. The rule that quantitatively holds up, and this applies across sectors, not just space, is to never initiate a position in a name that is already up more than 10 to 15% on the day without a verified, company-specific fundamental catalyst. A sector tailwind is not a company catalyst. A trending Twitter hashtag is not a catalyst. A confirmed contract award, an earnings guidance raise, a regulatory milestone, those are catalysts. The secondary rule is position sizing. Anyone who got hurt badly in this round trip today was almost certainly oversized for the volatility profile of these names. A stock capable of moving 20% up is equally capable of moving 15% down. If your position size does not account for that range, the math was always going to work against you. Eventually, space as a sector may have a compelling long-term thesis: reusable launch economics, satellite infrastructure, government spending on space domain awareness in 2026. These are real structural tailwinds. None of that changes what happened in the last 36 hours, which is a textbook lesson in the difference between a sector being interesting and a specific entry being intelligent. The people who will participate in the upside of this sector over the next several years are not the ones who bought yesterday's top. They are the ones who wait for the volatility to settle, identify the specific companies with durable revenue visibility, and enter at a price that reflects reality rather than momentum. So here's where we landed. A sector moved 15 to 20% up on thin volume and sentiment momentum, with no fundamental anchor strong enough to hold the weight. Predictably, it reversed. The open loop from the top of this video is answered. You now know the mechanism. But here is the follow-up question worth thinking about. If space infrastructure spending is genuinely accelerating in 2026, which specific companies in this sector actually have the revenue visibility to justify a long position at current valuations? That is the next video. Subscribe so you do not miss it.